Hello and welcome back to our channel. On our channel Ask Finance, we cover and explain various financial concepts. So if you want to learn more about the world of finance, please subscribe to our channel. Today we're going to talk about the three financial statements. The three financial statements are important because every public company has to publish them once a year. Why do we even care about the three financial statements? Well, they give a very good overview to investors and analysts of how a company has been performing. So its ability to generate cash, its assets and liabilities, and if the company has been profitable. The first financial statement that we're going to look at is the balance sheet. The balance sheet is a snapshot at a point in time of a company's assets and liabilities as well as shareholders' equity. It's often the end of the year, so the 31st of December. The balance sheet covers and displays a company's assets, like plant, property and equipment, PPE, but also the inventory and cash. But also a company's liabilities, so debt. So we have debt. But then it also shows the shareholders' equity. In a balance sheet, the assets always have to be the same as the liabilities and the shareholders' equity. So it has to be a balance. That's why the name balance sheet. Next up, we have the income statement. The income statement shows the performance of a company and its ability to generate a profit out of its revenues. In an income statement, the first line is always revenue. From there, we deduct several other expenses like cost of goods sold, operating expenses, depreciation, interest, and taxes, and we end up with the net income. One of the major differences between the income statement and the balance sheet is that the income statement is expressed over a period of time. It can be a month, a quarter, or a year, whereas the balance sheet is a snapshot at a point in time, often once a year at the end of the year. So that's a major difference. Next up, we have the cash flow statement. The cash flow statement, similar to the income statement, is expressed over a period of time. The cash flow statement shows a company's real cash in and outflows and undoes some of the accounting principles that we find in the other statements. So it shows a company's real increases and decreases in cash. The cash flow statement is separated into three parts. We have the cash flow from operations, we have the cash flow from investing, and we have the cash flow from financing. ending point is the cash balance. And the starting point is always net income. So the net income from the income statement is the first line in the cash flow statement. And then we add back non-cash expenses like depreciation, for example. Depreciation in the income statement is an expense and lowers our net income. But it's not a real cash outflow. A company is not paying someone. There's no cash flowing out of the company, which is why in the cash flow statement we add it back. And we have a look at investing expenses, where obviously real cash flew out of the company, and from cash from financing. An example is interest payments to bondholders, dividends to equity holders, and we end up at the cash balance. So now let's have a look at how the three financial statements are linked. As I already said earlier, the net income from the income statement is the first line in our cash flow statement. And our cash balance from the cash flow statement goes right here into the balance sheet, into the cash position. Our net income from the income statement can also be found in the shareholders' equity, in retained earnings. And changes in net working capital, so inventories plus accounts receivables minus accounts payables, which we calculate from the balance sheet. The changes in net working capital are subtracted or added back, depends on if it's positive or negative, to the cash flow statement. So you can see those three statements are all interrelated, they're linked with each other, and it's important for an investor or an analyst to understand the three statements, to be able to read them, to analyze them, and then to understand and interpret them. So that was a quick introduction and an overview of the three financial statements. If you found this video interesting, please give us a like and subscribe to our channel. Thanks, and see you the next time.